All right, welcome to Trading Nation. Today we're joined by Tom Lee. He is managing partner and head of research at Fundstrat Global Advisors. All right, Tom, without getting too into the bond weeds, as it were, and with stocks at record highs, a little bit of a drop on Monday, but stocks, let's call them basically record highs. Why is watching the high yield market and maybe the HYG ETF so key to you right now?
Well, Brian, you know, high yield bridges the world between credit and economics and the equity market. High yield is the lowest quality credit of the credit world, which means it has the most equity-like behavior. And, you know, a lot of our work, which looks at the inception of high yield for the last 30 years, stocks and high yield move together.
Okay, so when you look at high yield and you say it moves together, I would assume that we're looking at high yield as some sort of is warning sign too strong of a term, Tom, for the equity market?
Well, there's a lot of folks who think of tail wagging the dog, but historically, high yield makes moves before the equity market confirms them. So high yield historically rallies before stock markets finally bottom. You know, that happened in 2008. High yield began to rally. It happened in late 2014 where high yield began to weaken, even though the stock market rallied it towards the end of 2014, and of course it was an omen to 2015. And even in 2016, high yield began to rally in February 2016 hugely, and that was the basis for us really having conviction throughout 2016 that equities would finally catch up. So high yield, I think, is an important link because it gives us insights to what credit on the margin is telling us.
So what is it telling us?
Well, so we've written about this recently. High yield has performed quite well. So I would say at the moment it's not telling us to be worried, but then when you look at the cousin of U.S. high yield, which is European high yield, that market I think is beginning to show signs of pricing that is hard to explain.
And what do you mean hard to explain? Our job is to explain, Tom.
Yes.
Nothing should be hard for us. Why is it hard to explain? That makes me nervous when you say stuff like that because that's normally what we're good at. Yeah,
so there's two things I would point out in European high yield. One is that that market has rallied relentlessly this year. So unlike U.S. high yield, which if you pull up HYG's chart, it's acted flat, European high yield has had a great rally this year, but it's pushed the level of yield in Europe to 2.17%. So a European junk bond issuer can borrow money cheaper today than the U.S. government. And if you're double B rated in Europe, which is the higher end of junk in Europe, you're borrowing at 1.6. So you're borrowing 50 basis points cheaper than the U.S. government if you're a junk bond issuer in Europe. So that's the first problem. The second problem is that European high yield bonds are now implying a negative default rate. They're implying that nobody who's a junk bond issuer in Europe will ever actually default on a bond.
That's ridiculous.
I
mean, it seems ridiculous.
I'm
you think
a
you'd have at
troubled by
least
it,
one.
yes.
You know, even a low default rate is a couple percent.
Yes, I think it's telling us that monetary policy in Europe has now pushed the pricing distortion into European high yield, and now that risk spilling over into U.S. high yield. That would be, I think, the thing that's getting me.
Is it irrational exuberance in the credit market, at least parts of it?
That, if you're going to find evidence of it, it probably looks like it's happening in high yield. And we also, in our note last week, also just noted that today, a Japanese junk bond borrower is only borrowing 6 basis points cheaper than an investment grade borrower in Japan. So in other words, in Japan, they might as well get rid of credit ratings because they're not even distinguishing between investment grade and junk bonds.
Tom Lee, Fundstrat Global Advisors, giving us something else to worry about, default rates on European high-yield debt, but an important correlation perhaps, negative default rates, that's a first for me. Tom Lee, thank you so much.
Thanks for having me.
Folks, as always, thank you for watching Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.